This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, July 7, 2026, and this is the London session. Now, let's get into it. We are deep into the London session on July 7, 2026, and the tape is screaming risk-off. The Fear and Greed Index has collapsed to 14 out of 100, painting a picture of extreme anxiety across global markets. While gold is holding steady near 4,131.99 and the US dollar is absorbing flight-to-safety flows, the real drama is playing out in the divergence between the British pound and the euro, and the overcrowded shorts sitting on the Japanese yen. Let's look at the schedule. The primary catalyst keeping eyes glued to the screens right now is the Australian Reserve Bank's rate decision, landing at 4:30 UTC. This is a high-impact event that directly impacts Aussie crosses, including Aussie yen and Aussie dollar. We also have a quieter afternoon ahead, with the US GDP now estimate coming in on Wednesday and the New Zealand RBNZ decision on Thursday. But for this hour, the Reserve Bank of Australia decision is the variable that could disrupt the current flow.
And for the Aussie specifically, watch how the Reserve Bank of Australia statement interacts with the current CFTC positioning. With leveraged funds heavily long the Kiwi and Aussie dollars, any hawkish surprise could trigger rapid liquidation or, conversely, fuel a squeeze if the market misreads the tone.
Here is the snapshot as of 3:14 ET. We are seeing a classic safe haven bid. Cable is trading at 1.339, down a negligible 0.4% on the day, but firmly entrenched near its 5-day high of 1.34016. Conversely, euro-dollar is at 1.1437, down 0.4%, testing critical support near 1.1375. The broader market is dominated by fear. The fear and greed score is 14/100. And the VIX is sitting at a relatively quiet 15.81. This disconnect, extreme fear but low volatility readings, is the backdrop for everything we're discussing tonight. 3 headlines are moving the needle right now. First, UK house prices inched higher in June following recent moderation. Second, German factory output rose more than expected in May. And third, the Iran foreign minister stated that negotiations on a final deal won't commence if threats continue, coinciding with reports of renewed attacks near the Strait of Hormuz. The UK and German data are providing a fundamental floor for pound strength. The UK housing data supports the Bank of England's ability to maintain higher rates longer, while the German beat suggests the Eurozone isn't in freefall. But it's not enough to overcome the ECB's policy uncertainty. This divergence is why we see pound outperforming euro despite the broader risk-off environment.
But don't overlook the geopolitical noise. The Hormuz situation is injecting a risk premium into energy and shipping costs, which feeds back into inflation expectations. However, the fact that VIX is still at 15.81 suggests the market hasn't fully priced in a supply shock yet. We are looking at a delayed reaction where asset prices reflect normalcy, while sentiment reflects terror.
So the fundamentals support pound, but the risk narrative is still evolving. Let's dig into the mechanics. Let's start with cable. It's at 1.339, practically brushing against its 5-day high of 1.34016. It's the strongest performer in the major crosses today. Grid, what are we seeing on the chart?
Technically, this is a clean test of range extension. Price action at 1.33896 is consolidating right at the upper boundary of the last 5 days. We've seen consistent higher lows forming since the 1.32746 low, and the current candle is closing near its high. There's no wick rejection yet. The structure suggests buyers are defending the mid-range and pushing against the ceiling. I'm watching 1.34016 as a dynamic resistance. If we get volume confirmation here, the path opens up. But if we get a sharp rejection, we'll see a pullback toward 1.335.
And that volume is backed by significant institutional commitment. Look at the COT data. leveraged funds have added plus 16,522 contracts week over week to reach a net long position of plus 16,273. This isn't retail fear of missing out. This is speculative capital piling into sterling because they believe the Bank of England has more ammunition than the ECB. The flow confirms your technical observation. Pulse, money is following the yield differential.
Exactly. The CFTC positioning validates the macro thesis. The Fed funds rate is stuck at 3.63% due to sticky CPI at 4.17%, and while the Bank of England isn't hiking, they aren't cutting either. The UK economy, supported by those house price gains, is proving more resilient than the Eurozone. This net long buildup means that for every pip cable moves up, those leveraged funds are adding to their positions, creating a self-reinforcing loop of buying pressure. It's a structural advantage that technicals can amplify.
I want to inject some caution here. While the positioning is bullish, I challenge the idea that this momentum is sustainable without checking the yield curve. The 10-year 2-year Treasury spread is flattened to just plus 0.35 pp. A flat curve usually signals recessionary pressure, which eventually hurts growth currencies like pound. Plus, you're ignoring the VIX divergence. The VIX is at 15.81, which is complacent, but sentiment is at 14/100. When sentiment hits these extremes, correlations break down. That plus 16,273 net long position is exposed. If a shock hits, that leverage becomes a liability, not an asset. You might be looking at a liquidity trap disguised as a breakout.
That's a fair counterpoint on the macro backdrop, SPECTER, but technically we haven't broken the structure yet. The chart doesn't care about the yield curve spread until price action rejects 1.34016 decisively. Right now, the sellers are absent.
Switching gears to euro-dollar. It's at 1.1437, sitting dangerously close to its 5-day low support at 1.1375. The gap between price and support is less than 60 pips. CIPHER, what's happening with the flows here?
The flows are overwhelmingly negative. Leveraged funds have dumped 32,395 contracts in a single week to sit net short 32,644. This is active deleveraging. Unlike pound, where funds are accumulating, euro shorts are being reinforced every day. Asset managers remain net long, but speculative capital is actively betting against the euro. This creates a heavy overhead supply. Every time euro-dollar tries to bounce, those leveraged shorts are ready to step in.
That explains the lack of buying interest. On the chart, 1.1375 is the line in the sand. If this level holds, we might see a consolidation between 1.1375 and 1.14729, the 5-day high. But given the COT data, a break below 1.1375 looks highly probable. If we lose that support, the next psychological barrier is 1.14, which flips from resistance to support on the way down but currently acts as a magnet for sellers. I'm watching for a daily close below 1.1375 to confirm a breakdown. Until then, it's a fragile hold.
It's fragile because the ECB has no inflationary urgency to defend the euro. With US CPI at 4.17% and core PCE at 3.41%, the Fed is locked in. The ECB is facing uncertainty, and the German factory beat wasn't enough to shift the narrative. The broad dollar index is up, and the euro is the casualty. The net short position of 32,644 tells me that the market expects further weakness. There's no fundamental reason for a sustained rally unless the Fed pivots, which isn't on the horizon.
And let's talk about the VIX again. 15.81 is deceptively low. If euro-dollar breaks 1.1375, we shouldn't expect a slow grind down. Given the disconnect between fear and volatility, a breakdown could trigger algorithmic selling that spikes volatility instantly. The low VIX means there's no hedging activity around these levels. It's a vacuum. A break here could lead to a gap move rather than a smooth technical decline.
Finally, let's address the elephant in the room, dollar-yen. It's at 161.875, pulling back from its 5-day high of 162.598. CIPHER, you mentioned earlier that yen shorts are overcrowded. Walk us through the risk.
It's staggering. Leveraged funds hold a net short of 115,400 contracts, with a week-over-week change of 117,107. This is one of the most crowded trades I've seen. The entire speculative community is bet on yen weakness. The problem is, when everyone is on one side of the boat, even a small wind change capsizes it. If dollar-yen pushes back above 162.598, those shorts face margin calls. They have to buy back yen to cover, which pushes the price higher, triggering more stops. It's a mechanical cascade waiting to happen.
Technically, the pullback to 161.875 is interesting. It's rejecting the 162 handle multiple times. This suggests that while the trend is up, the upside momentum is exhausting. However, I agree with CIPHER that the risk/reward for short here is terrible because of the positioning. If we see a breakout above 162.598 with volume, it won't be a gentle climb, it will be a vertical spike due to that forced covering. I'm watching 162.598 as a binary trigger. Above that, the shorts are dead water.
The macro supports this squeeze potential. The U.S. yield curve is steepening relative to the yen, and the Fed is hawkish. There is no fundamental reason for the Bank of Japan to intervene immediately, especially with softer wage data that failed to derail hike expectations. The carry trade remains attractive. The short interest of 115,400 means that any uptick in U.S. yields or any dip in yen bond yields will accelerate this move. The crowd is wrong, and the size of their error is massive.
My concern isn't just the squeeze, it's the timing. The VIX is at 15.81. Markets hate uncertainty. The Iranian headlines about Hormuz are adding geopolitical risk, but the volatility hasn't spiked yet. If the VIX stays suppressed while dollar-yen rips higher, it creates a false sense of security. When the correction finally comes, it will be violent. That 115,400 short position is a loaded gun. I wouldn't chase the long here chasing momentum. I'd wait for the volatility to expand before considering a fade.
Let's touch on gold. Gold is at 4,131.99, down 0.61% intraday, but holding well above its 5-day low of 4,030.82. Is this a healthy consolidation or a sign of fading safe haven demand?
Price action is consolidating between the 5-day low of 4,030.82 and the 5-day high of 4,203.23. Today's low was 4,124.51, which acted as immediate support. The chart shows a flag pattern after the initial surge. As long as 4,124.51 holds, the structure remains bullish. A break below 4,124.51 would signal a deeper retracement toward 4,030.82. Currently, it's respecting the lower boundary of its recent range.
Flows are mixed but biased toward holding. We saw capital rotate out of risk assets like RC and Kiwi into gold, but also into dollar. The net position isn't as extreme as it was for pound or yen, which suggests gold is acting as a hedge rather than a directional bet. Investors are using it as insurance against the geopolitical risks from Iran and the tech sell-off. It's not a momentum play right now, it's a portfolio shield.
With CPI at 4.17%, real yields are pressured. Gold benefits from high nominal rates combined with inflation fears. The fact that it's holding at 4,131.99 despite a minus 0.61% dip shows underlying strength. The macro environment, sticky inflation and geopolitical tension, is perfectly aligned for gold. It's not just safe haven demand, it's inflation hedging.
The danger is that gold is being used as a proxy for everything else. If the VIX spikes unexpectedly due to a Hormuz escalation, gold could sell off initially as margin calls force liquidation across all portfolios. The low VIX reading of 15.81 means there's very little put options protection bought at these levels. If we get a shock, the lack of hedging could cause a temporary flush below 4,124.51 before buyers step back in. Be careful assuming the support holds without volume confirmation.
To tie this together, Grid identified the technical fragility of euro-dollar at 1.1375, which CIPHER confirmed is being hammered by a net short of 32,644 contracts. Meanwhile, cable is standing firm at 1.339, supported by a bullish net long of plus 16,273 and technical consolidation at highs. But SPECTER is right to warn that the VIX at 15.81 is dangerously disconnected from the 14/100 fear score, meaning any technical break could be amplified by hidden liquidity voids. And for dollar-yen, CIPHER data on the 115,400 short position suggests that a move above 162.598 would trigger a mechanical squeeze, a risk pulse highlighted with the hawkish Fed backdrop.
So, the key themes for the remainder of the London session. Cable is testing resistance at 1.34016 with strong structural support. Euro-dollar is balancing on a knife edge at 1.1375 with heavy short positioning overhead. And dollar-yen carries the latent risk of a short squeeze if it breaches 162.598. Tomorrow, watch the Aussie dollar reaction to the Reserve Bank of Australia decision and monitor whether the VIX begins to expand as the fear index remains pinned at 14. Stay disciplined, manage your risk, and we'll see you on the next session. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the New York pre-market, where we will see how these calls play out. Until then, trade safe.